Okay. So, like I was saying, group cash flow. When we talk about group cash flow is just talking about how we are to consolidate the cash flow statement of the entities within a group. And as we all know, when we talk of consolidation, it's just the adding of line by line item of the financial statements. However, based on the knowledge we've already had with separate entity financial statement, a financial statement cannot be a financial statement cannot be prepared without having prepared the statement of profit or loss and the statement of financial position. That being said, it simply means that the what's it called? Before we can prepare group cash flow, we must have prepared the consolidated statement of profit or loss and the consolidated statement of financial position. And this way, consolidating the cash flow becomes very easy. It becomes very easy. Now, when we are consolidating cash flow, the areas that the areas that needs attention is one, the non-controlling interests. As for non-controlling interest, the issue we will have with it, with non-controlling interest is determining what's it called? The dividend paid to the non-controlling interest during the year. You know, the entity, the subsidiary entity might have declared dividend during the year, and portion of the dividend will be paid to the parent based on their percentage of holding. That remaining portion will be paid to the NCI. So determining the dividend paid to the NCI is very easy. We just prepare our NCI account, bring the opening balance and the closing balance, then take the profit that is attributable to them during the year to the account. And if we still have any difference, that difference would have represented the dividend paid to them during the year. However, if we have acquisition or disposal of subsidiary during the year, we also need to adjust for it. But as we adjust for it, we'll look at it when we'll look at just the normal way. The value of NCI acquired or disposed during the year. If it's acquired, we'll be taking it to the same side where we have the opening balance of the NCI, which is the credit side. If it is disposed, we'll be taking it to the debit side of the NCI, the value of the NCI that is acquired or disposed. You know, acquiring an NCI simply means the parent company disposed part of their holding in the subsidiary. And disposing of an NCI simply means the parent company acquired more to their holding during the year. That's that. For associates or joint ventures, how does it affect the cash flow? What will affect the cash flow as it relates to associate or joint venture would be the share the dividend received from the associate during the year. However, the share of the associate profit during the year must have been added back. You know, as an associate, because we have a significant influence, what do? We share profit. But that profit we are sharing is not a cash item. So when we are adjusting our profit before tax, because the associate share of profit would have been included in it, we have to adjust for it. I mean, if we are using the indirect method. So, but whatever we have as whatever we have as dividend received from the associate is what we will now take as part of our investing activity. And if we acquire more shares in the associate, entirely an associate investment is what? Is an investing activity. So the acquisition or disposal of an associate will be taken to where? will be taken to our investing activities. But where we give a loan to the associate or we receive a loan from the associate, we'll take those ones to financing activities. We'll take it to financing activities. Same way we calculate dividend paid to NCI, we also calculate dividend received from associates. By doing what? The associate balance at the beginning of the year on the debit side of the associate ledger, the share of their profit on the same side, the balance at the end of the year on the credit side, and with that we can determine what will be the okay, with that we can determine what will be the, what is it called? We can determine what will be the dividend received from the associates. Now, when we acquire a subsidiary or we dispose a subsidiary during the year, we have to be careful. If we acquire or dispose a subsidiary during the year, automatically the group account at the beginning of the year, if we acquire a subsidiary, the group account at the beginning of the year will not include the subsidiary information because the subsidiary was acquired during the year and they couldn't have what's it called, consolidated at the beginning of the year. But the group information we'll be having at the end of the year would have been inclusive of the new subsidiary acquired. So when we are doing our adjustment, we have to be careful. The subsidiary information that was acquired during the year must be added to the opening balances to know what is actually the cash movement during the year, because it wasn't included in the opening balances. But if it is disposal, then the subsidiary information will be part of the opening balance, but it will not be part of the closing balances. And if it is not part of the closing balances, when we are doing when we want to adjust to know the cash movement, we must also be taking out the information of the subsidiary from the opening balances to know what is the actual cash movement. That is very important. Then when we acquire, there is also what we call the net cash acquired. Net cash acquired. You know, if one of the assets we will acquire from the subsidiary is their cash balance, and if part of the consideration we are paying is also a cash, then we calculate the net cash. Because I want to buy the entire company for 100 million. Part of what I'm buying is 20 million cash, and I'm also supposed to pay you 40 million for the acquisition. I'll just give you the net amount. That's the best way. So we calculate the net cash, and the net cash goes to the investing activities section of the statement of cash flow. That is basically what we have on statement of cash flow. Like I said, it's nothing serious. So let's just look at 2-3 questions before we run away tonight. Any question before I proceed? Any question before I proceed?
Hello, sir.
I'm with you.
Yeah, please, sir. This value adjustment you did on YouTube, I'm unable to get the first part of it. So I can only find the second part. Can you assist us
Hallelujah.
in
What topic do you say?
fair value adjustment, sir?
Fair value adjustment. I will check it, but most likely is in the previous video. Before we do fair value adjustment, we would have done I think purchase consideration. So you can check the video of purchase consideration.
No, sir. The video of purchase consideration, the video of purchase consideration, you don't finish it up. So you ended in the last part of the what is it called? Uh,
Don't
what is
worry,
it?
let's talk after this.
Okay, sir. Thank you,
Is
sir.
there any question on group cash flow for now? Any question on group cash flow for now? If there are no questions on group cash flow, Ladies and gentlemen, someone with a sonorous voice, I did not say any voice, so sonorous voice should read question 2 for us.
Sir, good evening, sir. I would have asked question, but I joined late. That was why I just kept quiet. Like the explanation, I didn't really get
I like
anything.
I like as you respect it like that you don't want to ask question. Don't worry, read question 2. But when we solve a question and you still don't understand, feel free to ask me. I grant you that permission.
Okay, sir. Thank you. Question two. Sir, please go to the requirements.
Are you first thing first? Is your voice sonorous?
Fortune, read.
Our voice is so low.
That's your requirement. So yeah, don't let it.
Okay, required. Prepare a statement of cash flow for Tasty Desserts and subsidiaries for the year ended 31st December 20x2 using indirect method. Sir, please can you scroll up?
Ọlọ́run máa má jẹ́ kọ́mọ ìfiscoding pa mí dànù.
The following are extracts from the financial statement of Tasty Desserts and one of its wholly owned subsidiaries, Costa Custard Powders. The shares in which were acquired on the 31st October 20x2. Statement of financial position. All figures are assumed to be correct. Sir, please can you scroll up?
Scroll low.
The following information is also given. 1. The consolidated figure of 31st December 20x2 includes custard powders. B. The amount of depreciation on property, plant and equipment during the year was $78,000. There were no disposals. C. The cost on 31st October 20x2 of the shares in custard powders was $1,068,000, comprising the issue of $695,000 unsecured loan at par, 120 ordinary shares of $1 each at a value of 280 C and 55,000 in cash. D. No write-down of goodwill was required during the period. E. Total dividend paid by Tasty Desserts, the parent, during the period amounted to $63,000. Required. Prepare a statement of cash flows for Tasty Desserts and subsidiaries for the year ended 31st December 20x2 using the indirect method.
I don't seem to understand because
So I cannot hear you. Am I the only one? So I cannot hear you.
I think it's his network.
Sir, we are not hearing you.
Like he has even left. So
Is it his network is coming?
Bro, see how you do now. I just get somebody. I just get somebody. I just expect her. I don't know how you do.
He said it is network.
Okay, okay. Good evening, everyone. I'm back, better and stronger. For those of you attacking me, it's fine. I know you guys now, and I'll deal with it accordingly. I think the network actually did that way because, so as I was saying, can you guys hear me now?
Yes, sir.
Yeah, they not attack you.
Okay. What do you say? So this question is having dollar as its currency. India and US are fighting at the moment. I don't want to do anything that relates to the US. So we will not be doing this question. Let's take the next one. Oh, question one also has to do with dollars. We will not do. We can't be doing dollar question. Question three also has
All
to
the
do with
questions
dollars.
are in Ghana.
Ladies and
Let's
gentlemen,
go.
let's agree to disagree that we are done with this topic.
Sir, please. Oh.
Let's agree to disagree that we are done with this topic.
So let's change it to another currency.
Will you get the exchange rate on that day for us? Thank God you've done foreign subsidiaries, so you can do the conversion. Okay,
Sir, we have not
we
done
have
foreign
this
subsidiary.
desert go. It's for those that used to come to class early now, not for people like you that comes to class late. Tasty desert go. What do we have there? They have a wholly owned subsidiary, and by now we should be conversant with what a wholly owned subsidiary is. Wholly owned subsidiary is a subsidiary in which the parent owns the 100% of their shares. So, but if you look at it, they were acquired on 31 October 20x2, and we are preparing statement of cash flow as at 31 December 20x2, meaning it was a mid-year acquisition. So we will have statements of cash flow for the year ended 31 December 20x2. So we have dollar in thousand, operating activities. Notes. So we have what? As we all know, using indirect method, we start with the PBT. So the consolidated PBT, profit before tax, is how much? 666. Then what do? We do the adjustment. Adjustments for what? Adjustments for those items that are not operating in nature, and also those items that are non-cash transactions. So if we look at this PBT, can you guys hear me?
Yes, sir.
Yes, sir.
If we look at this PBT, what makes up the PBT? We have the PBIT, which will definitely be the operating activities. We have a finance cost. Finance cost is not an operating activity, so we take it out. Finance cost. Finance cost is zero here because, as you can see, no cost is allocated to it. So we can just ignore it since there was no figure to it. The next one we have is share of associate profit. And share of associate profit, like we have said earlier, is an investing activities. share of associates profit. Moreover, the share of the profit is not a cash transaction. It is the dividend that will be a cash transaction. But since it was added to get the profit before tax, we'll be deducting it back so as to adjust for it. Having treated the non-cash, having treated the non-operating activity we have there, we check with the additional information. We have the consolidated figures at 31 December 20X to include custard powders. Very necessary. It should have. The amount of depreciation on PPE during the year was 78,000. And we already know that one of those things that would have made up the PBIT, which is the major thing in our PBT, is depreciation. And depreciation is a non-cash item. So we bring it here and say depreciation of PPE. 78,000. It should have been deducted before. So we'll be adding it. We have the cost on 31 October 20X2 of the shares in custard powder was this. Comprising of this. Okay, we'll come back to it. No write-down of goodwill. Good. Total dividend, it doesn't affect our SOPL. If that is all, I don't think we have anything else affecting our SOPL or that would have caused a difference in our statement of in getting our profit before tax. So the summation of this will be how much? That should be 42 negative, right? Then we move straight to changes in working capital. Please, I need you guys to be confirming you can hear me or not.
We can hear you, sir.
Changes in working capital, we have inventories. Inventory, which is 1388 at the beginning of the year, but now 1735. If it was separate entity financial statement, we'll just take the difference and we are good to go. But because this is a group cash flow and we have an acquisition during the year, we'll come to our notes. Note 1. Inventories. What is the change? Balance carried down is how much? 1735 dollar in thousands. Less balance brought forward, which is how much? 1388. Then the one acquired during the year. You know, the one acquired, the subsidiary figure will be part of this 1735, have it? And we only compare likes with likes. So we have to add that one. So they gave us the value of the asset on the date of acquisition to be 306. So with this, we'll add this to be how much? 1694. Have it? 1694. We take out 1694 from this. What do we have? We have an increase in our inventories. By how much? Figure.
41.
41 or 21?
$41.
Increase. Huh?
41.
41. Oh, sorry, don't mind me. Yeah, you're right. 41. Increase in inventory, note 1, that's 41. And if our inventory is increasing, it means we are buying more inventory. And purchase of inventory is an outflow of cash, so we put it in bracket. The next is our receivables. Receivables. We have balance carried down, 2658. Less balance brought forward, which is how much? 2436. Then the value of the one acquired is how much? 185. So what do we have? Two, 4, 3, 6, 185. That will give us how much? 2, 6, 2, 1, Abby. Hello?
The difference is 37.
Sir.
37. An increase also. And an increase in receivable is also an outflow of cash. Increase in receivables. Note 2, 37. We move to this next one. Bank balances and cash is a cash and cash equivalent item. So we move to the next one, payables. Payables also increased. Payables also increased. We go to note 3, payables. Balance carried down is how much? 1915. Less balance brought forward, which is how much? 1546. And the one acquired, which is how much? 148. So what do we have? Hello? This will give us what? 1694.
1694.
So what do we have as the difference? It's also increasing. How much?
221.
221. If it's increasing by 221, an increase in payables is an inflow of cash because it means we've gotten more items on credits. 221. And that's the last thing we have. Bank overdraft is not an operating activity. Tax payable is also not categorized as core operating activity. So what do we have as the value here? That will give us cash flow from operating activities. Figure
299. Total changes in working capital.
it cannot be 299. God forbid batting. 221.
143.
143. Good. 143 possible. And the
Oh, sorry.
summation for cash flow from operating activities will be what?
67.
Huh?
767.
767 according to Fortune 2025.
767.
So to get the tax paid, we prepare the tax account, the tax payable account. And what do we have in the tax payable account? We have the balance brought forward. And we have two types of tax here. We have the current tax and the deferred tax. For that person that is stealing from the pot, please be careful. Current tax has an opening balance of 200 and deferred tax have an opening balance of what? 180. Balance carried down. Income tax has an opening balance, closing balance of what? 235. Deferred tax has a closing balance of how much? 111. With this, what do we have? Okay, for the year, the tax charge for the year is what? 126. So what is the total here and what is the balance? Figure. Figure. Hello? I'm getting 160. Is that what you also got?
I think so.
160. If 160 is the tax paid, what will be the net cash flow for the year? Net cash flow from operating activities, please.
607.
607. So we can then move to investing activities. So for our investing activities, we get the information from the what? From the non-current asset section. And from the non-current asset section, we have PPE. PP and E. PPE accounts. We have balance brought forward. Sorry, that's a very big blunder. Balance brought forward on the debit. 3685. And balance carried down 4764. If we acquired during the year, we acquired 694, and there was a depreciation charge during the year of how much? 78. In the absence of any other information as it relates to PPE, what do we have as the total? And what do we have as the balance? Hello?
The total is 442.
And the balance?
463.
463.
Yes.
463. Okay? If that is 463, that means that's the value of the PPE acquired during the year. Acquisition of PPE 463. Since it's an acquisition, that will be note 5. Goodwill. We don't have goodwill at the beginning of the year. We did not inherit any goodwill, but we are having 42 at the end of the year. That is, since they told us there was no written down goodwill, no write down of goodwill was required during the year. That means there was no impairment of goodwill. To just confirm that figure we have there is the goodwill from the acquisition, we can calculate goodwill. And how do we calculate goodwill? Purchase consideration, which is how much? They told us the total purchase consideration was what? 1086. 1086. Then, since it's a wholly owned subsidiary, there will be no NCI. So the next thing to do is to less fair value of net assets. Fair value of net assets. However, you can also show, you can just write NCI there and put it as name just to show them that you understand the NCI is supposed to be there. But since it's fully owned subsidiary, there will be no need for it. Less fair value of net assets. So what will be fair value of our net assets? Since we don't have any group adjustment here, the equity, remember, we say it's the same thing as the what? It's the same thing as the net assets. So what will this give us? What will it give us? Hello?
That's 42.
That's 42.
So the 42 is what we have in our goodwill account. So if we have our goodwill account this way, no balance brought forward. But during the year, through acquisition, we have 42. Abi? Then at the end of the year, we have balance carried out of 42. That means there was no change during the year, no movement. But as we calculated it to be 42, let's assume we calculated it and it was 45. And we have in the SO FP to be 42. Now what do? We know there has been what? An impairment. And what does that imply? We have to go back to our operating activity and go adjust for the impairment there, because the corresponding entry for that impairment would have been in our SOPL. Right or right?
Right.
All right. I can't tell you right or right.
The first one.
Okay? If you insist it is right, then I don't have objection. But if you say it is right, then I have objection. Any which way, let's proceed. Having done that, PPE is sorted, goodwill is sorted, investment in associate. What's going on? Investment in associate. We have balance brought forward 2175. There was no acquisition of associate during the year, but we have a closing balance of 2195. But don't forget, from this associate, we share their profit during the year to the tune of how much? We shared 120 from them as profit. And as it is credited in this SOPL, it will be debited here. Share of profit 120. So what we are supposed to be having as total is 2295. But we have 2195. That means what? That means there was a dividend received, which is cash, of how much? Of 100. So we say dividend from associate 100. Figure. So having done dividend from associate, is there anything left? We don't have anything in our non-current asset again. So are we done with investing activity? Are we done with investing activities? Hello?
The money we used to buy the fully cleaning, like coastal
God
powder.
bless you. We need to calculate the net cash acquired. That will be note 9. Net cash acquired from the subsidiary. We'll say what? Cash acquired. The cash of the subsidiary is how much? 7. Cash paid or cash consideration is how much? They told us what? This 1,086,000 is funded by 695,000 unsecured loan stock at par, 120,000 ordinary shares at the value of 280 cents, and what? 55,000 in cash. That cash is the one we have issues with now. So if the cash we paid to acquire is 55,000 and we acquired only 7,000 cash, the net cash will be what? 42. Is that not it? Is it 42 or 48? 48.
Yeah, proceed.
Net cash acquired. $48. It will be an outflow because we overpaid. We paid more than the cash we acquired. So what will be the net cash flow from investing activities?
$411.
Positive or negative?
Negative.
Then we can go to financing activities. For financing activity, we don't have anything like that in our SO here because the finance cost we have there does not have a value. So we leave that out. We go to the equity section. The share capital was 476 at the beginning of the year. Now 4896. How come? Did they sell shares? Note 10. OFC account. Balance brought forward. The imbalance carried down. 4896. But on the acquisition of the subsidiary, they told us what? They told us they sold 120,000 ordinary shares of $1 each. So that will give us how much? 120. So that's what? 4896. So that means the movement in our share capital is not cash. It's to pay for the acquisition. So we leave that out. It's not coming to our cash flow. Note 11. We have share premium of 216. Where is the share premium of 216 coming from? Come back to the additional information again. The 120,000 ordinary share they said they sold. The nominal value is $1 each, but they sold it at the value of 280 cents. 280 cents converted to dollar will be 280 cents divided by 100 cents. Meaning it should be $2.8. So if it is $2.8 and the nominal value of the shares is $1, and we use that to multiply the 120,000 shares that was sold How much would that give us? 216,000. That's what explains the 216 we have. But at the same time, it is to finance acquisition. So it's not coming to our cash flow. Note 12. We go to the next one. We have what? Retained earnings. The same way, retained earnings. We'll have what? Balance was for what? 2063. You know, their equity items. That's why their balance was forward is coming to the credit side. Balance carried down 2540. Then the profits for the year is how much? 540. So we add it up. That will give us what? 2603. 2603. The difference, which would have been the dividend paid during the year, is 63. And they even told us that in the additional information that they paid dividend of 63,000 during the year. So we'll come here. Dividend paid to shareholders, or let me say to owners of Tasty Desert. Note what is it? Note 12. Note 12. How much is it? 63 is an outflow. And what else do we have? We have loans. Loans increased from 653 to 1348. You go and adjust for it also. Loans account. Balance brought forward 653. Balance carried down 1348. Okay. So there was a loan issued for the acquisition 695. Say acquired 695. And then we add it up. This will give us what? 8 4
1348.
So that means the increase was as a result of the acquisition. It's not coming there also. The next is what? That is all we have. Deferred tax has already been treated. So net cash flow from financing activities. -63 negative. What do we have as the net cash flow for the year? And what will we have as the net cash flow at the beginning of the year?
133. Total net cash flow.
133. Positive or negative?
Positive.
Okay. So before we get the net cash, the net cash flow at the beginning, we have to adjust our cash and cash equivalent. Why? We have one cash and cash equivalent item here. We have another one here. So we'll say note 14, adjustment of cash and cash equivalent item. So what do we have? 20x2, 20x1. We have bank balances and cash. 43 and 77. Bank overdraft. Bank overdraft is what? 176 and 343. Figures, please.
Or 20x2 is negative 133.
Uh-huh.
20x1 is negative 260.
Negative what?
266.
266.
So if we have negative 260 here as balance at the beginning of the year, what is this supposed to give us?
Negative
Figure
133.
negative 133, which tallies with our balance at the end of the year. Are we good? Are we good? Hello? Any question? Hello?
Hello, sir. I'm with you.
No
I
question,
can't hear
sir.
Now
anybody.
we can hear you. We'll go over it,
Hello.
sir.
I don't know. People are just joining and leaving, joining and leaving. Okay? Someone with the sonorized voice can read the next question.
Question one. Topiary Co. is a 40-year-old company producing garden statue carved from marble. 22 years ago, it acquired a 100% interest into a marble importing company, Astorf Co. In 20W9, it acquired a 40% interest in a competitor, Landscape Co. And on 1st January 2007, it acquired a 75% interest in garden furniture design. The draft consolidated account for the Topiary Group as follows. All figures are going to be correct. So please scroll down.
This assumption will not kill you guys one day.
Note, there had been no acquisition or disposal of building during the year. Machinery costing $1.5 million was sold for $1.5 million, resulting in a profit of $300,000. New machinery was acquired in 20x7, including additions of $2.55 million acquired under finance lease. Information relating to the acquisition of garden furniture designs All figures are going to be correct. Start please scroll. Okay. Loans were obtained at a discount in 20x7, and the current amount of the loans at 31st December 20x7 included
Nonsense.
$120,000, representing the finance cost attributable to the discount and allocated in respect of the reporting period required before the consolidated statement of cash flow for the topiary for the year ended 31st December 2027 as required by IAS 7 using the indirect method. There is no need to prove notes to the statement of cash flow.
Okay. Since I've done the first one, I believe you can do the second one yourself, right?
No.
Topiary group. Hmm. Looking for. Ṣé ẹ ti paná fíìsì? So for topiary group, they've given us a lot of details, but we are preparing statement of cash flow as at 31 December 20x7. And of all the acquisition information they gave us, is only this garden furniture designs that was acquired at the beginning of this year. Meaning it will be the only one that is information will not be in the opening balances we have. So we'll have consolidated statement of cash flow, for the year ended 31 December 20x7. Are we there? Are people still on this call?
We are here, yes,
So as usual, operating activities. Profit before tax. How much? 5655. Then adjustments. What are the adjustments we have? Before we have that profit before tax, we have share of profit after tax of associates. It's not an operating activity. Share of profit after tax of associates. So we'll take it out. 1050. It was added before, so we will be deducting it. Income from long-term investment is not an operating activity. 600. We'll take it out also. Interest payable. 450. It was added before. We'll be deducting it. It was deducted before. We'll be adding it now. Are we there? After that, we look at the additional information. Is there anything there that can help us? No acquisition or disposal of building during the year. Good for us. Machinery costing 1.5 million was sold for 1.5 million, but resulted into a profit of 300,000. Automatically, you know that profit is a non-operating item, non-operating activity. So we say profit on disposal of 300. It should have been added before, we'll deduct it. Number next, new machinery was acquired in 2007, including additions of 2.55 million acquired under finance leases. Good for them. All of this, their home palava. Loan was obtained at a discount, including, that's none of our concern for now. Okay, having treated all of that, the next thing that they were silent about, which we ought to have, is depreciation charge for the year. So that will take us to our non-current asset. If we look at the non-current asset, we have building. Building that was valued at 6,006 at the beginning of the year is now 6,225 at the end of the year. Mind you, at that beginning of the year information does not include that of garden furniture designs. But if you look at garden furniture designs, they don't have building, so no problem. So we'll just adjust the building notes. Note 1, building. Okay, let's use ledger. Building. Balance brought forward 6,600. Balance carried down 6,225. Since they told us no acquisition, no disposal, what would have caused the difference? The only thing that could have caused the difference is depreciation. Since we've also checked the equity and there is nothing like evaluation, surplus or deficit there. Figure.
375.
375 is the depreciation on building during the year. Depreciation, building. 375 would have been deducted, we had it back. The next one is machinery. For this, we can use the splitted approach. We have note 2, machinery accumulated depreciation. Phoebe, are you still part of this class? Otilosun. Accumulated depreciation opening balance will be on this side, on the credit side, because it's the value in asset, 3,300. Balance carried down will be here, 3,600. Then the two things that would have caused change to this would be the depreciation charge for the year, which is the unknown. But we were told that a machinery that cost 1.5 million was sold for 1.5. But they told us it resulted into a profit of 300,000. The only way it would have resulted into a profit of 300,000 is because there was depreciation. The accumulated depreciation on the asset as a debt is what? Is 300. Are we getting it?
Mr.
And that would have made this to be 3,009. Mongba or Mrs.
Phoebe.
Phoebe from where?
Oh.
So this is the disposal
We're
account.
looking for Phoebe now.
When the machinery itself, they said it cost 1.5 million. For 1.5 million. But with that disposal, there was a profit. You know, profit would have been credited in the SOPL. It will be debited here. SOPL. 300. That will make this account 1,800. The only thing that would have made this account not to balance is the accumulated depreciation on that machinery they are disposing, which will also be 300. Is it clear now? So depreciation on machinery would be 600. It was deducted before also. We need to add it back. Goodwill. Fine. Goodwill was 300 at the end of the year with nothing at the beginning. No amortization or anything on goodwill. Investment in associates. Investment in associates actually increased from 3,000 to 3,300. Okay? But we know investment in associates, what should have affected it is that share of associate profit, which we have treated. Long-term investment did not change, so there is no way it's affecting our SOPL. That being said, we can close this out. What's the total for our adjustment column? Changes in working capital.
Um, 525.
Positive or negative? Talk. Positive or negative?
Negative.
So for working capital, we go to inventories. 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 What do we have for inventory? Balance carried down. 5,925. Less balance brought forward. 3,000. The one acquired of inventory. Chai. Okay. Inventory acquired is 96. So what do we have? As increase.
Two eight two nine.
I hope I have 28,
Two
29.
nine.
Acquired for receivable is 84. Balance brought forward is 3825. While balance carried down is 5,550. Figure. Cash is a non is not a is not part of the working capital that we are considering. It's not an operating activity. Go to liability, payables.
Receivable is 1641.
1641.
Receivable.
Payables balance brought forward is 184. Balance carried down is 1,500. Less balance brought forward 840. Less the one acquired. What do we have? 204. What do we have? It's still increase. Mm. Figure.
456. 456.
45 what?
456, yes.
456. Increase in inventories 2829. Outflow. Increase in receivables 1641. Outflow. Increase in payables 456. Inflow. Obligation under finance leases is not an operating activity. Income tax is to be treated later.
4014.
4014. What is the cash flow from operating activities?
Can you scroll up?
One 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 six.
1116. Then we go to the tax paid. To get the tax paid, note 7, tax payable account. Balance brought forward. Income tax. We have what? 651. Deferred tax. We have what? 39. Then SOPL. Balance carried down. Income tax. How much? 1386. Balance carried down. Deferred tax. How much? 90. Summation. In our SOPL, what do we have as tax? 1620 as the total tax, regardless of the particulars they give it. Income tax, or deferred tax, or tax attributable to investment income. All join. How much is it?
1476.
1476.
76.
2310. And cash paid, tax paid is 834.
2310.
Yeah, tax paid 834.
Cash 834. So if we take out 834, what do we have as the net cash flow from operating activity? Cashflow.
Sir,
That's 282.
I heard you went for Umrah, you did not come to class on Saturday.
282.
Yeah, I'm after
282.
Lagos. That's I'm online. No.
282.
Yes.
Okay. Investing activities. Who said is online?
Apoteri.
Have we met before?
Apoteri. Yo.
I never
Nah,
doubted it.
Kotiwura
I'm only asking if we have met before.
Yes.
Investing activity. We've already looked at building. There was no acquisition, no disposal. But for machinery, there was a disposal. So we'll say disposal proceeds. For machinery, how much? 1,500. And that will be an inflow of cash. Then again, on that same machinery, they told us there was acquisition, but they did not tell us how much was the machinery they acquired. So note 8, machinery accounts. That is the cost account. We have balance brought forward, 4,200. Then balance carried down, 9,000. What are those things we have? First of all, disposal. How much? 1,500 is the cost of the machinery that was disposed. And what else did they tell us? They told us that what? They acquired new machinery, which include a 2.55 million that was acquired under finance lease. So we'll come here, finance lease, 2,550,000. If that's the only case we have, then what do we have as the balance? What do we have as the difference? This is 10,500. 10,500. Cash is how much?
3,750.
3,750.
Yes, sir.
That's because we don't have any other information that can influence our machinery. There was no revaluation surplus, no what's it called? No other addition except cash. So 3,750 acquisition of machinery.
Sir, I have a question.
Go on.
They gave us machinery for garden furniture. Are we not going to add that one?
Chai, thank you very much for that brilliant submission. They acquired machinery for that one, so we are supposed to include it. So we are supposed to have the one acquired here. So that will change what our acquired is how much? 495. So what do we have? That gives rise to us realizing
3255.
that there was a mistake. There was a mistake in the tax also, because the acquired tax liability also of how much? Of 51. So that will give us how much? 3255. What do we have for the tax?
885.
As what? As the difference
As the
or as
cash
the
paid,
total?
yes. The total is 2361. The cash paid is 885.
Eight eight five. So what is the net cash flow?
That's 231.
Okay? Having done that, we've already ascertained goodwill. No issue with goodwill. Investment in associates. What we need that for is to calculate what we need that for is to calculate the what is it called? Is to calculate the dividend paid.
So we have our now.
So what do we have in investments in associates? Balance brought forward. How much? Balance brought forward. How much? 3,000. Balance carried down. How much? 3,300. Why the profit share for the year is how much? 1050. That will give us a total of what? 4050. The dividend we received would have been how much? $750. Dividend from what was it called? Associates. $750. That's an inflow. Okay. So what do we have next? Investment income. We have income from long-term investments. $600 is an inflow. We look at here, investment did not change. So that means the income is the only thing we have from it. And if that's all we have there, what do we have as a net cash flow? Net cash flow from
405 in
investing
bracket.
activity. Hmm?
405 in bracket.
It cannot be in bracket, mama. 15 plus 750 plus 600 minus 3255 cannot be 400 something.
Negative
Should be
405
lesser.
in bracket.
Oh, negative 405. Oh, sorry. I thought you
Yes.
meant 4,000 and something. Financing activities. We have equity. Share capital also increased from 6 million to 11 million. Ordinary share capital accounts. Balance brought forward 6,000. Balance carried down 11,820. On the acquisition, they said the usual shares as part of the consideration 825. So we'll have acquired. For the acquisition, they issued 825. But if that's the only, we did not calculate net cash acquired. Net cash acquired. So what's the net cash acquired? Cash acquired, the cash they are getting from the subsidy, from the this thing is 336. Cash paid for the acquisition is how much? 42. So with this, the net cash acquired is how much? Mm-hmm.
294. 294.
294. But that's an inflow because the cash we are acquiring, net cash acquired, the cash we are acquiring is more than the one we pay, 294. So this is what do we have?
In jacket.
I'm with you.
The net cash flow from investing 111 in jacket.
111 in jacket. Net cash flow from investing activities. For financing activities, what do we have? So we have proceeds from share issue. Because if the shares they issue for the acquisition is just 825, but their shares increased to 11,820, then there must have been another share sold via cash. How much would that be? $4,995. $4,995. That's an inflow. Share premium must also increase. Wait, oh, please, let's pay attention. They told us it is 2.64 million shares that was issued as part of the consideration, but they gave us the cost to be 825. We have to come back here and check what is the nominal value of their shares. The nominal value of their shares, that means what I have here is wrong. Very sorry. What should be the value here? $2,640,000 times 0.25. That's 25 cents. And that will give us how much? That's 660. This should have been 5,160. Are people still here? Are people still here?
Yeah.
Yes,
Hello?
sir. Yes, sir.
We can hear you, sir.
Yes, sir.
So in our share premium account, we'll have balance bought forward of how much? 6285. And the balance carried down will be 8649. The premium on the shares for acquisition will be what? 825 minus the 660. If 660 is the nominal value of the shares issued for the acquisition, but what we are giving it is 825. So the excess has to be the premium, and that's 165. So what will be the cash?
2199.
2199. So that will give us 8649. 8649. 2199 as the cash inflow from it. We move to the next thing, retained earnings. Like here now, they did not tell us how much was paid as dividend during the year, so we have to prepare the retained earnings account to determine the value of the dividend. Balance bought forward 7,500. Balance carried down 10,335. SOPL, that is profit for the year, but you know what you'll be taking is the one attributable to owners of the parent. You can't take profit for the year for it because you take their home portion and their share of the associate portion. 3735. And what will this give us in total? 11,235. If this is supposed to be 11,235, what's the difference?
900.
900. That means that's the dividend paid. 900. So we'll come here. Dividend paid to owners of parents, 900 negative. Then after retained earnings, we have what? NCI. So we also need to know what's the dividend paid to NCI by the subsidiary. So for NCI also, we have balance bought forward. How much? Nothing. There was no balance bought forward because the NCI, but we have balance carried down to be how much? 345. But there was an NCI on the acquisition of the subsidiary of how much? 189. So acquisition 189. So what do we have? The difference will be the dividends. Sorry, share of profits. Share of profit. SOPL. The associate share of profits for the year. This NCI share of profits for the year is 300. That means this should have been 489. 489. Dividend
144.
144. So dividend paid to NCI 144. Then we can go to the next thing. Finance lease. Balance brought forward. Please, both the current and the non-current. Can we add it up? 5. Then balance carried down. How much? 130 plus 720. 130 plus 720. That should be 2850.
Plus 1
Huh?
Okay.
This is it now. 2830. 720.
Okay, sir.
Have you seen it? So there was a PPE acquisition during the year. The one we debited here, 2550. Corresponding entry is coming here, 2550. And what else do we have? That's all. So if that's the case, this should be 3660. 3660. So what was the cash payment to these people during the year?
810.
Sir, wait, please. How did we get 1110 for balance brought forward?
510 plus 600, the current and the non-current. Are you clear now? Finance lease payments. $810 is an outflow. Then loans. For the loans, balance brought forward, how much? 1,500. Balance carried down, how much? 4380. So what will be the summation? Before we do summation, there was an additional information. Yeah, they said loan were obtained at a discount in 20x7, and the carrying amount of the loan at 31 December 20x7 included 120,000, representing the finance cost attributable to the discount and allocated in respect of the current reporting period. The finance cost attributable to the discount should go to the finance cost account, not included in the loan balance. The finance cost attributable to the discount should go to the finance cost account, not here. So we'll say, since it's already included in this, we'll bring it to the opposite side and say finance costs. $120. So SOP, sorry. Oh, mm. So that means we got more cash from loan during the year. And how much will that be? 2760.
That's
So we have proceeds from loan. So what? 2760. Then the finance charge or finance income. Finance cost. Balance brought forward 90. Balance carried down 120. Then that one we are bringing from the loan 120. SOPL. The one charge in the account for the year, interest payable 450. So this will give us how much? 540. 540 minus 2. The cash paid during the year will be 300. So finance cost paid 300. So what do we have as the net cash flow from financing activities? What's the figure?
7965.
What is the figure?
7965.
7985.
7965.
7965.
6 or 8. Positive or negative?
Positive.
Positive.
So what is the net cash flow for the year? Add the 3 up, please.
7791.
Oh, your move. 77.
91.
7791.
So I got like 8085.
You got what?
8085.
Huh?
I got 8085.
So it's okay. Oh,
8085.
808 what?
8085.
8085. Oh yeah, you guys should fight each other. 8085 is actually correct. 8085. Net cash flow.
8085.
So have you recalculated it?
Yes,
Net
yes.
cash
8085.
flow at the beginning.
8085.
at the end. Welcome back, everybody. You guys just wake up, Abby. Well done. So the cash, we only have one cash and cash equivalent item here. So that's why we don't need to bother calculating any adjustments. Opening balance 5460. If we add it up, what does it give us? 5, 4, 5, 13, which is the same thing as the closing balance here. Ladies and gentlemen, if it is the same, we are good. If it is not the same, we are wrong. Is it right or right? Right or right?
Right. The second.
Right or right?
All right.
Yeah. You need anything? Hmm? Hmm. Can we proceed to the next question? Hello? Ó yá ẹ sọ̀rọ̀.
Sir, 11
Hello?
ti lò.
You people should talk.
Can
Should
we
we
call
call
it
it
a
a time
time?
or proceed to the next question?
Can we call it a
Good
time?
night, sir. Good night,
Eh?
sir.
Let's call it a time.
Who is that person saying good night? Did I say I'm done with
It's on.
this thing? I asked the question. The final decision is still in my hand. I can say yes, I still want to do the next question. Or I can say no, go and sleep. I've not said this
Sir,
is
let's
my
go and
position. You
sleep,
say good night.
please, sir.
What's the meaning of that?
But, sir,
Eh?
I have a question.
Ask your question.
This one that you solve now. Okay. Okay.
Mm-hmm. This one that I saw, what happened to it?
Uh, I wanted to ask is, you said you wanted to teach us the one inside the mock exam, like the question one. It's not cash flow, it's IAS one, but you've not taught us yet.
Tanya, who said I have not
It's
taught
me.
them IS1?
No, the one in the mock exam question, the number one there.
Yeah. We'll still do it now, but not tonight. You guys, you don't want to wait for me to solve the last question on group cash flow. You say I should do question one or more. I'll still do it. Maybe most likely on Thursday. So let's do it this way. I'll release us to go sleep now.
Okay.
It's already 11 o'clock. Then on Thursday, God's willing, just spare our lives and everything be